Manishi Ray Chaudhary as well is on board with us. Manishi, good going last 3 sessions. What's driving the euphoria?
Partly short covering. There were large short positions that had been built up in times of currency volatility. Obviously, those are being closed because I think the last couple of measures that were announced by the RBI governor have possibly had the effect of stabilizing the currency at the current levels. It's too premature to talk about appreciation from these levels, but at least the currency has stabilized in the 65 to 66 range. I think the swaps with the oil companies and the inflows into the FCNRB deposits, or the potential inflows rather, that have gone down well with the market. And I think this round of short covering may continue for some more time. But at the same time, I must also say that this is nothing structural. In fact, the core problems of India, which center around a fiscal deficit and a current account deficit and the consequent crowding out of private investment, that continues to remain. And as a consequence, we get a sense from our conversations with international investors all across the world that any pop of this nature may be used as a selling or kind of rebalancing opportunity on their India weights at a later date.
So you're telling your clients that don't celebrate the market rally. In fact, this comeback is a good time to cash out or to log out?
Our advice is to possibly stay neutral to slightly underweight on India. In fact, in our Asian portfolio, we have a neutral on India. This contrasts with a pretty significant overweight position that most GEM and Asia ex-Japan investors have. They have close to about 1.5 to 2% overweight if you take an average of these investors. Yes, we think that the pops of this nature would possibly provide some profit booking opportunities in some of these stocks. At the same time, there are beaten down good quality names which would qualify as long-term holdings, and they would possibly generate alpha over a 12 to 18-month period. But they're unlikely to do so over the next 1 or 2 quarters.
Manishi, at the current juncture, I guess the easiest thing is to make a bearish kind of a scenario. Earnings are contracting, GDP is contracting, there are concerns on top line as well. But even though the track is bad and the macros are not supportive, foreigners have not panicked. We've hardly seen any outflows in the month of August and early part of September. What explains that?
If you look at last 3 months, India has lost somewhere close to about 3.8 to 4 billion. And while the initial round of selling, which was in June India lost about 1.76 billion. That was actually in keeping with what happened all across Asia. But in July, and to some extent in the second half of August, the situation turned slightly adverse because the selling in India was also accompanied by positive inflows into North Asia. We saw positive inflows into Korea, into Taiwan. Taiwan had pretty significant positive inflows in the month of July. And anecdotally, also into China, particularly the FAI-linked stocks. So our recommendation has been actually to move into North Asia. And that trade of moving out of Southeast Asia and India into North Asia has actually been going on for a couple of months, possibly from around mid-July or so. As you rightly pointed out, the macroeconomic data points are yet to improve. The one single data point that one should watch out for over the next 2 to 3 months is the trade deficit. I would be particularly keen to see whether the trade deficit stays at current levels, even if it moves up slightly to about 13.5 to 14 billion per month. I think it would be satisfactory because the low trade deficit number in June and July were supported by relative lack of economic activity and the non-wedding season that we encountered during that period. So there are a few data points yet to watch out for before we can conclude that the macroeconomic slowdown and other headwinds are behind us.
So Manishi, what happens? Another 100 points and the market hits a ceiling, or do you think the market has enough legs and we may see 6,000 levels as well?
See, in the near term, it's very difficult to predict what would happen over the next few days. because there are just too many variables that are looming in the horizon. First, we have the monetary policy statements, both from the US Fed and from the Reserve Bank of India. We also have a few macroeconomic data points coming through pertaining to inflation and trade deficit, which would come through over the next few days. But I think the real leg to this pop that we are seeing is the short covering, that, the positions that had been built up over the last few days. And that's really difficult to predict in the sense that how long it would go on. If it goes to about 6,000 or so on the Nifty, which would correspond to somewhere close to about 19,500 to 20,000 on the Sensex, I would think that that would provide a good opportunity for investors to lighten up their positions on India and get closer to a neutralish position. Actually, the best situation for India is when investors would go back to a neutral to marginal underweight position. That's when India really becomes underowned. And when the valuations decline to about one standard deviation below the long-term averages. That's almost a no-brainer support level for India, and that is where long-term institutional investors should get really enthused about India. That is where it would provide them a good money-making opportunity.
Look at the Bank Nifty up 300 points, and this is coming on the back of a 10-12% appreciation the Bank Nifty registered on Thursday and Friday. Yes, bulk of the market action in the Bank Nifty is a function of short covering, but prices are there, and no one is really pouncing to create some kind of a short position, at least on the Bank Nifty. So the Bank Nifty is once again the big talking point. IndusInd Bank is up another 5%. You look at the 5-day chart for IndusInd Bank or Yes Bank, it will look very encouraging. But the minute you superimpose it with the 1-month chart or with the 2-month chart or the 3-month chart, these banks are nowhere close to their recent highs. Manishi, what is your take on private banks now? Do you think all the bad news in stocks like IndusInd Bank, HDFC Bank, Yes Bank is behind us? Because these are still good quality franchises, and these banks have done a great job of conducting themselves very well in times of crisis.
Within the private sector banks, there are two kinds. I would like it to make a distinction between the ones that are wholesale funded and the ones that have a decent degree of CASA. So from that perspective, I would think that the likes of HDFC Bank or ICICI Bank are relatively safe because their CASA levels are high and therefore their funding costs are sustainably low. The banks that are wholesale funded, the likes of Yes or IndusInd, would still have some risk to their balance sheet and P&L account purely because the liquidity tightening measures that RBI adopted in mid-July are likely to continue for some more time. That's our opinion. And until and unless we have a stabilization of the currency, and that depends not just what happens to the domestic scenario, but also what happens externally in terms of the developed market and US bond yields. Until and unless that situation stabilizes, we don't think that the liquidity tightening measures would be reversed. And as a consequence, the cost of funding for the wholesale funded banks would stay at an elevated level. So while I would think that this round of correction provides a good entry opportunity for the CASA funded banks, HDFC Bank or ICICI Bank, and among them the high quality ones, about the wholesale funded banks, I would still stay slightly cautious.
What happens to IT then, Manishi? Is the recent dip that we're seeing in IT as a pack a good opportunity to start lapping up more stocks? Or do you think, again, we should sell out?
I think IT is something that we're unequivocally positive about. There's one indicator that I have talked about on this forum and many others, which is the Philadelphia Fed survey of 6-monthly capex. That is clearly showing a very strong uptick. And we must remember that these American companies who talk about capex are operating at low capacity utilization. And therefore, when they talk about capex, that really centers around productivity improvement, which is obviously good for that Korean DRAM manufacturer or the Taiwanese chip maker or the Indian IT service provider. The gains from the rupee would obviously show through in this quarter and the next. Some companies, of course, have hedges which would lead to losses below the operating line. But I think it's the operating margin that the market would focus on. And that is likely to be a very encouraging piece of news for the entire IT sector. So we have an overweight on Indian IT, and there's no reason to unwind it at the present moment. In fact, I would think any decline should be used as a buying opportunity there.